What if I told you a company just locked in $49 million in deals in 3 months, but Wall Street is still treating it like a penny stock lottery ticket? Welcome back to Smart Stock Sam, where we cut through the noise and follow the money. Today, we're diving deep into Datavault AI, ticker DVLT, and the question everyone's asking. Is this thing actually about to explode, or are we watching another overhyped tech story collapse? Because the developments we're seeing right now, the partnerships being announced, the revenue projections management is throwing around, they're either setting up one of the biggest small-cap runs of the year, or we're all about to learn a very expensive lesson. Stick with me, because by the end of this video, you'll know exactly what's real, what's speculation, and whether this belongs anywhere near your portfolio. Let's start where the smart money goes, behind closed doors. CEO Nate Bradley didn't just host some Zoom call with investors. He organized a private strategy dinner at Mar-a-Lago, bringing together high-net-worth investors and senior government officials to discuss real-world asset tokenization. This isn't your typical startup hustling for attention. They're also running a massive global campaign on Bloomberg television. When a micro-cap company is buying airtime on Bloomberg and getting FaceTime at Mar-a-Lago, something is shifting. The question is, are they positioning for a genuine institutional wave, or is this all expensive theater designed to pump retail interest before insiders cash out? Here's where it gets interesting. Datavault just turned the Super Bowl into their technology stress test. Over Super Bowl weekend, they deployed their proprietary ADIO data over sound technology and DVE Holo holographic systems to authenticate and monetize live audience engagement. Think about that for a second. The Super Bowl is one of the highest noise, most chaotic environments you can imagine, and they chose that as their proving ground. If the tech can handle that level of complexity and scale, what does that mean for everyday commercial applications? But more importantly, did it actually work, or are we looking at a marketing stunt disguised as technological validation? Now, we need to talk about who's actually using this technology, because partnerships mean nothing if they're just press release filler. Sports Illustrated is building a proprietary digital asset exchange on Datavault's infrastructure. NFL Alumni Health is leveraging that ADIO technology for real-time public safety messaging. These aren't random endorsements. These are established brands with reputations to protect, integrating Datavault systems into their core operations. The question you need to ask is, are these pilots that could evaporate in 6 months? Or are we looking at long-term strategic relationships that generate recurring revenue? Let's get into the numbers, because this is where the rubber meets the road. In Q4 2025 alone, Datavault signed $49 million in tokenization and licensing agreements. Not projected revenue, not hopeful pipeline, signed agreements. For a micro-cap company, that's not just impressive, it's a fundamental shift in credibility. But here's the catch. Signed agreements don't always translate to cash in the bank. We've seen companies announce huge deals that later get restructured, delayed, or quietly disappear from earnings reports. So the real question is, how much of that $49 million actually converts to recognized revenue, and when does it hit the balance sheet? Management is setting a baseline of $30 million plus for fiscal 2025, which represents 1,000% year-over-year growth. Let that sink in. A 10x jump in a single year. If they hit that number, it confirms they've exited the prove the concept phase and entered what I call the velocity phase, where growth compounds on itself. But here's the risk. High growth projections from management are often aspirational, not contractual. We've all seen companies miss their own guidance and watch their stock get obliterated. So is this $30 million conservative and achievable, or are they setting themselves up for a catastrophic earnings miss? The revenue roadmap is where things get absolutely wild. The guidance for 2026 is $200 million. For 2027, they're targeting $2 to $3 billion as their real-world asset tokenization strategy hits full maturity. If those numbers even come close to reality, we're not talking about a stock that doubles or triples. We're talking about a complete revaluation, the kind of move that turns early investors into legends and late arrivals into bag holders. But let's be brutally honest. A company going from 30 million to 3 billion in 2 years? That's not a growth curve. That's a moonshot projection. What has to go perfectly right for that to happen? and what's the probability they actually pull it off. To hit those kinds of numbers, you can't rely on one-off events and individual partnerships. You need infrastructure, scale, and national reach. That's where the 100-city expansion comes in. Starting in the second half of 2026, Datavault is rolling out an AI-driven monetization network across 100 cities in the US, specifically targeting healthcare, insurance, and finance. These are high-value verticals where data monetization isn't just profitable, it's exponentially profitable. But deploying across 100 cities requires massive capital, flawless execution, and regulatory compliance in dozens of jurisdictions. So the question is, do they have the operational muscle to pull this off, or are they biting off more than they can chew? The tech that makes this all possible is their SanQtum AI platform, running on GPU-powered edge nodes. This allows for local, real-time data processing at the point of origin, which is critical for monetization speed and security. Edge computing is legitimately the future of AI infrastructure, and if Datavault can own even a small piece of that market, the valuation potential is massive. But edge computing is also a brutally competitive space, with giants like Amazon, Microsoft, and Google already dominating. So can a microcap really compete with trillion-dollar companies, or are they carving out a niche that the big players don't care about yet? Now let's talk valuation, because this is where things get fascinating. The stock is currently trading between 72 and 74 cents. The analyst target? $4. That's a potential 5x return if the target holds. But here's what you need to understand. Analyst targets are not guarantees. They're educated guesses based on assumptions that may or may not play out. We've been seeing a clear sell into news pattern where positive announcements actually drive the stock down, which suggests either profit-taking, skepticism, or coordinated selling. However, we're also seeing a consolidated base forming, which often precedes a major breakout. So is this base a launch pad or a trapdoor? Let's address the elephant in the room, shareholder dilution. The capital needed to fund this hypergrowth has expanded the share count significantly over the past year. There's also an active S-3 shelf registration for up to 5 million shares, which means they can issue new stock at any time, creating immediate downward pressure. Dilution is the silent killer of small-cap returns. You can have a company that grows revenue 10x, but if they dilute shareholders 15x in the process, you actually lose money. So the critical question is, are they done diluting, or is this just the beginning of a capital raise cycle that bleeds existing investors dry? Timing is everything, so let's talk catalysts. February 15th, 2026 is the big one. That's when full Q4 results drop, and we'll see if those $49 million in agreements actually translate to revenue, or if there's a gap between what was signed and what was booked. After that, watch for the maturation of these licensing deals in the first half of the year. Then, the real test comes in the second half of 2026 with the 100-city rollout. Each of these is a binary event. They either execute and the stock explodes, or they stumble and the whole thesis collapses. Before we wrap up, let me be crystal clear about something. Nothing I've said in this video is financial advice. I'm not a registered financial advisor, and you should never make investment decisions based solely on YouTube videos. Do your own research, understand your risk tolerance, and consult with a licensed professional before putting real money into any stock, especially volatile microcaps like Datavault AI. The stock market is inherently risky, and you can lose everything you invest. This video is for educational and informational purposes only. So here's the bottom line. Datavault AI has validated technology from a Super Bowl deployment, commercial momentum with 49 million in signed deals, and a roadmap that could take them to $2 billion in revenue. If they execute on the 100-city expansion and hit even half of their revenue projections, the current valuation gap represents a legitimate opportunity. But if they miss on earnings, struggle with the rollout, or dilute shareholders into oblivion, this could be a painful lesson in why most microcaps fail. I'm watching February 15th like a hawk. Those numbers will tell us everything we need to know about whether this is the real deal or just another overhyped story. If you found this breakdown valuable, Smash that like button, subscribe to Smart Stock Sam for more deep dives, and drop a comment telling me if you're watching DVLT or staying far away. I'll see you in the next one.